Okay, so the first one, purchased merchandise inventory. So the first question is quite obvious. This is a purchase transaction. Okay, um, we're buying inventory. So inventory is going to be one of our accounts, and we're buying them on account. So we know that is it accounts receivable or payable? Payable, right? This is money that we owe our vendor, and it's $8,000. Okay, so the first journal entry, inventory debit, we're getting this asset, and it's going to be $8,000. Okay, and this was, I think, what was it, November 4th. Okay, first one, done. Second, we paid freight bill of $160 on November 4th for this purchase transaction. So again, uh, in purchase transactions, when we pay for freight, we're going to capitalize that, right? We're going to store it as an asset because we want to match that cost of inventory with the revenue whenever we sell that item. Okay, so let's say, I'm just going to add a little flavor here. Let's say this was for, we had bought 50 items. Okay, 50 units of some item. Not only, and let's say it was $8,000. So our total unit, and of course your company would have to have some methodology to do this. And I'm assuming we're just buying one item, which is maybe not necessarily the case, but it'd be $8,000 divided by 50 units. So that's how much it is per unit. And then this $160 for freight divided by 50, that's the freight per unit, right? So really, when we did cost of goods sold, when we sold this, let's say we sold 10 items at some point, our cost of goods sold would be this times 10, which includes not only the cost of the item plus the kind of per unit shipping cost, right? So this 1,632 would be my cost of goods sold if I sold 10 of them. Okay, does that make sense? How that freight cost would eventually be expensed? Yeah, because again, this is my cost of goods sold for 10 units. Okay, so until then though, it's going to be stored in inventory, just like this 8,000. So it's going to be inventory, and it said paid for, so we're going to assume it's cash. We returned half the inventory purchased. Okay, so um, this shipping cost is like kind of a sunk cost. We're not going to like undo half of that. Okay, because it doesn't say we're paying for shipping, return shipping or anything. We're just gonna uh, basically not owe $8,000 anymore. Okay, so AP, right now it's a credit balance. I want it to be 4,000 because I'm only going to pay for half the items because I'm returning half of it. That means we're going to have to debit accounts payable 4,000. So I have half my journal entry here. So then what am I going to do? What's the other half? So AP is debited. What should I credit? Yes, merchandise inventory. Exactly. And again, even if it was an allowance, in this case, it says it's a return, so we're actually giving the items back. If it was an allowance, we would still do this same entry. Why? Because the inventory account is not a physical count of inventory. It's the value of the inventory. It's how much we've paid for it. Okay? So if we were given an allowance, even though the physical item was still there, the value of it from an accounting perspective is zero because we're not going to pay for it, right? The vendor is going to subtract that off from how much we owe them. Okay, so I think this is a key concept to remember, that the inventory account and the physical unit count are not the same thing. The inventory account is just keeping track of our cost of the inventory, how much we've paid for it. Okay, so it could be that we have stuff in inventory that we didn't pay for because it was given to us as an allowance. Okay, so let's just do this next one, and then we'll keep working. Sold merchandise inventory for cash, 1,700. Cost of goods sold, 680. Now look, I'm giving you a little preview of next chapter. They're just telling us this cost of goods sold. Okay, all of chapter 6 is how did this cost of goods sold come about? It's going to be, we're going to have to do we're going to have to know the units, the number of units, the unit cost, but that's all going to be in the next chapter. Okay, so For now, though, we're just told what the cost of goods sold is. Okay, so it's a little easier. Next chapter, we're going to double click into cost of goods sold and understand that better. But for now, it's a little simpler because they're just telling us. Okay, so again, for every sales transaction, how many journal entries are there? Okay, one for the revenue, one for the cost of goods sold. Okay, so it's telling us our revenue. The revenue part of it is 1,700. This is how much our customer is paying us. So we're going to have some sales revenue. And in this case, they're paying us cash. That's what it said right here. Inventory for cash. Cost of goods sold is 680. So this is the first journal entry. The second one, we do cost of goods sold. That's our expense. And our inventory asset is reduced by that same amount. Okay, so we left off November 11th. Okay, so this is another sales transaction. Okay, so sold merchandise inventory to this corporation on account. Here's our revenue, 10,300, and our cost of goods sold is 5,150. It's giving us all these credit terms because we sold it on account. Okay, so again, for cash transactions, it's irrelevant to have credit terms because you've already received the cash, right? So the credit terms are only for when you're buying or selling on account, because you're trying to incentivize, either your vendor is trying to incentivize you to pay sooner, or you are trying to incentivize your customer to pay you sooner. Okay, so in this case, we're trying to get our customer to pay us sooner. Within 10 days, we're going to offer them a 3% discount if they pay us within 10 days. Okay, so, but we don't know what's going to happen, right, when we record this transaction. So we're just going to go one step at a time. Again, we're assuming that they're not going to take the discount, and we're going to record the full amount of the revenue. Okay, so we're going to record 10,300 in revenue. And again, it's called sales revenue, not service revenue, sales revenue. And it's for accounts receivable. And you can label it by the customer, okay, just so we know whose account receivable is whose. Okay, because when they start paying you off, you're going to want to know what their outstanding receivable is, because some of them are going to do returns, etc. So you want to keep track of how much they're owing you when they pay you off. Okay, so that's the first part of it, because again, every sales transaction has two parts. So that's to record the revenue. The second is to record the expense. This is again sell high. This second one is buy low. How much should we buy this inventory for? So cost of goods sold, debit, because it's an expense. We have to reduce our inventory asset by the value of this inventory, because it's no longer an asset for us. It's gone. We've given it to our customer. So we have to reduce this inventory asset by that value. So again, cost of goods sold is converting an asset into an expense, because it's, you can think about it in a couple ways. You had to pay for that inventory that you bought. You had to pay for that inventory that you sold, so you're recording how much you paid for it. Or you can think about it as like, you no longer have inventory, right? It's gone. So you have to reduce that asset. Okay, and the value of it was 5,150. So it's a pretty, you're making a big margin on this. You bought the items for 5,150 and you sold them for 10,300. But the way you'd calculate the margin is it's the cost of goods sold divided by the revenue. So it's a 50% gross margin. Okay, so that's just one transaction. This is one sale. Okay, so this is both of these are related to this transaction. Because again, each sales transaction has two journal entries. Okay, we paid freight for the November 10th sale. So again, I asked myself the first question, is it a purchase or sales transaction? So this one is related to a sales transaction. And when we pay freight for when we're the seller, we expense it right away, because again, that's like a service I provided for my customer. That's an expense for me in that period that I generated the sale. Okay, so this is going to be November 12th. You can call it freight expense. This is like a selling expense. This is like an expense that is part of your, it's like a cost of doing business to generate the sale. Just like if you had a salesperson, you pay them a commission. It's like a similar thing. Okay, so and I think it said we're paying with cash. Okay, everyone good with that? Yeah, you're gonna have another one where you're paying freight for a purchase transaction. So again, that's gonna be treated differently than this. Okay, so let's just do one more. Sold merchandise inventory to this different customer for 9,000 on account. We offer them some credit terms, and then our cost of goods sold was 4,500. So again, we're gonna assume that they're not taking the discount. So we're gonna record the full amount of. So I can basically just copy and paste these. It's the same accounts, except I'll just change this to, instead of Gunnison, it's California Corporation. Okay, and I think it was 9,000. And then my cost of goods sold was 4,500. Okay, so it's the form is the exact same. So, and it's going to be for every sales transaction. It's just going to be different customer, and you can see we offer them different credit terms, right? So you'll have to go look back once they pay us off and see what the credit terms were, what the discount was. But for now, we're not worrying about that yet because we don't know ahead of time when they're going to pay us. Let's just do this the 14th, and then I'll let you guys keep working. So paid the amount owed on account from November 4th, and they're giving you a hint here because there is a return and there's some discount. So let's see. So November 4th, we were offered 110 net end of month credit terms. So we had it until what day to pay this? Okay, so look, this date of this transaction is exactly on the last day to get the discount. So we're going to get the discount of 1%. Okay, we also had a return here. Okay, so they gave you a big hint about doing this journal entry because they're telling you the net of the discount and the return. So that you should already be cluing into being like, okay, well, what were the credit terms, and let me see how much I returned, just so you kind of it's a big hint because you would have to be tracking these in T accounts to like have seen otherwise. Okay, so initially we had an account payable for 8,000. So we started off at 8,000. We, from this return, if you look back, we had a debit to accounts payable of 4,000 because we returned half of it, this 4,000. So right now, our total outstanding balance is 4,000. Everyone good with that? And of this, how much cash are we going to pay them? 4,000. We know that this is going to go to zero because we're going to pay them off. But are we going to pay them the full 4,000? No, we're going to pay them 99% of it. But I know that I need to debit accounts payable 4,000, right? Because I need this accounts payable to go to zero. So I'll just start with that, 4,000 debit to accounts payable. I know I'm going to be paying some cash, but it's not if I wasn't getting the discount, it'd be easy. It would just be this. But since I'm getting a discount, I know the actual amount of cash I'm paying is less than that, right? So the amount I'm paying is this times 99% because I'm getting a 1% discount. Okay, so I save 40 bucks. But this is not a valid journal entry. I need to have a $40 credit to something. So what should I credit? Inventory. Yes, that's right. So look, this is, as it stands, my balance of inventory is 4,000. So before this journal entry, it's saying that the inventory I have is my cost is 4,000. Now, is that my actual cost? How much did I actually pay for this inventory? Yeah, 3,960. So it should be this, right? 3,960 or 40, is it? Yeah, no. Okay, so then how do I get from 4,000 debit balance to 3,960 debit balance? What do I need to do?
1%.
I'm not using subtracting. What is it? You're right. You're right. But we don't use addition and subtraction. Exactly. Thank you. You need to credit inventory by $40. And so once I have this credit to inventory for 40, I will have the correct amount I paid for this inventory. So that's where this credit to inventory fits into it. So now my inventory balance correctly reflects my actual cost of that inventory. Okay, so I think we left off on this. So November 16th, after negotiations, we granted Gunnison $200 allowance. So if we look back up here, AR for Gunnison, and I kind of want to start a T count for these account receivables because we're now having returns and allowances and stuff. So we initially had 10,300. I'm giving them an allowance, so they're only going to owe me 10,100. So in order to do that, I need to credit their account receivable. This is Gunnison by 200. So I know I'll have a credit to AR Gunnison, and I kind of have to undo some revenue, right? Because that's like less than I could say that I've generated in sales. And again, we could do this, and that would be coherent, but we have these contra accounts that we're going to use to track when our customer takes discount or when we have a return or allowance. So instead, we're going to move this to our sales, returns, and allowances account. Okay, and I only have to do this one journal entry because it's an allowance where I'm not getting those inventory items back. So I don't have to do anything with inventory or cost of goods sold. Okay, that's the difference in a sales transaction between returns and allowances. With allowances, since you're not getting the physical item back, it's a loss. I already expensed it because it's like kind of left inventory, and it's not coming back in this transaction because it was just an allowance. So that cost of goods sold that I originally recorded is correct. Okay, I don't need to adjust it at all. So on the 17th, I received defective inventory from the 13th sale. So this is from California company. Originally 9,000. So again, I'm going to start another account receivable for California company. It was 9,000, and it's saying that I'm giving. They're going to return $400 worth of items. Okay, so that's how much. Like on the revenue side, it's worth 400, right? That's how much the related value in revenue was. So I'm gonna have to reduce the amount they owe us by 400. Okay, and then so it's gonna be the same kind of transaction as we had here, at least this first half. It's gonna be AR California instead. Okay, so 400, 400. But since this is a return and not an allowance, I'll have a second thing I have to do, which is to put that inventory back. Okay, I'm putting it back into inventory. I'm getting that item back, and I'm going to reduce cost of goods sold by the value of the inventory, 200. Okay, everyone good with that? Again, there's no contra account for cost of goods sold. We're just going to directly do a weird thing and credit a expense account. Okay, so that's this this system is it's not always super consistent. Okay, you could ideally say, hey, why don't you have a contra account for cost of goods sold that is credit normal, but just the way that we set up our books and the way we're learning, we're just going to directly credit cost of goods sold. But if you were the controller of the company and you wanted to track these returns separately, you could set up a contra account to cost of goods sold. That it would still get you to the same like end product, but you just have one extra account to track in your accounting system. Okay. Okay. So November 18th, another purchase transaction. So again, I'm just gonna kind of copy and paste. It's gonna be this. 3,700, 3,700. This is AP. I guess you can track the AP separately. This is to Rainbow. That's our vendor, not our customer, because this is a purchase transaction. Okay. All right. So now there's a bunch of payoffs. So I just want to make sure that you have a chance to try this on your own. As you can see here, like Gunnison, this is my account receivable. So when you calculate the discount, it's going to be on this 10,100, not on this 10,300. Same thing with California. It's on this discount is going to be on this 8,600. 20th. Okay, so received cash from Gunnison Corporation, less allowance and discount. So I have the accounts receivable balance for Gunnison here. And this is net of the allowance, right? We had a $200 allowance. So this is how much they owe us on a gross basis before the discount. Okay, so will they get the discount? Let's see. Okay, we offer them terms of 310 net end of month. So they had till the 21st to pay us. And we can see here that they are paying us on the 20th. So yes, they will get this 3% discount. Okay, so 3% means that they're going to pay us 97%. But 97% of what? It's going to be 97% of this outstanding balance. So I can just do a quick calculation here. We're going to receive $9,797 in cash from Gunnison. That's the check that they're going to write us, because it's going to be for the amount they owe less the discount. Okay, so I'm just going to debit 9797 right now. I at least have figured out this very common sense thing. 9797 debit to cash. The other easy thing I know that has to happen is that I need a credit of 10,100 to AR Gunnison, because they will no longer owe us any money after this. So I know that this account has to go to 0. So I'm going to put a credit here, 10,100 to accounts receivable Gunnison. Every journal entry, number 5 here, do our debits equal our credits? No, it doesn't. Okay, so I need to fill this in with the $303. Now, I could do sales revenue, and that would be coherent, because really, when I first recorded this account receivable, I like kind of puffed myself up. I'm like, I'm going to receive X amount of revenue, but I'm actually receiving less than that because they got this discount. Okay, so I got to reduce my revenue. But again, we have actually a separate contra account for discounts when our customers take it. It's called sales discounts. Okay, we paid off the amount owed on this one. We're getting a 2% discount because we had it till the 28th. And again, this is a discount that we're taking as the purchaser of inventory. Okay, so this is going to be different, where we're going to deal with our inventory balance, right? So I just want to figure out how much cash I'm paying. So I do 3,700 times 98.98. So this is 3,626 is how much cash I'm going to pay. So I know, again, this is how I start these calculations. I just figure out what is the cash being transacted, and I know that there's a discount. So this is the amount I'm paying to my vendor, 3,626. So I'm just going to put that first as a credit, 3,626 cash. I also know that my accounts payable has to go to 0. So I initially recorded it I think it was here, 3,700 credit. So I know I need to do 3,700 debit. And of course, there's a difference here that I need to bridge. And this is going to go to reduce the value of my inventory. Because my inventory balance was debit 3,700. I'm going to credit it to get it in line with how much cash I actually paid. Okay, so the next one is received cash from California company, less return and discount. So again, we have this is our balance net of the return. California company had 115 net 45, so they had till the 28th to pay. They're paying on the exact last day to get the discount. So they're going to pay us in cash 99% of this. So I'm going to multiply it by 99. So it's 8,514 is the cash we're receiving. Okay, so this is the cash coming in. My accounts receivable for California needs to go to 0, which I think was 8,600. Okay, so I need to bridge this gap of $86, and that's going to go to sales discount. And then the last one, purchase inventory, and we paid freight. So it's actually 2 separate transactions. You could combine it into one because it's all going to be debit to inventory, credit, cash. So you could do it like this. You could do it as 2 separate transactions. Or you could have, sorry, 12,000. Or you could have just made this 12,200. Now, you have some discretion as the accountant how you want to do this, because all that matters in the end is that your ending balances are correct. Okay, so both of those two are going to give you the exact same balance for inventory and cash, but you would just have to write a memo so that the manager or whoever understood what this what was the economic reality of that journal entry, like what was going on, because it's not clear by just looking at it what was happening. So you would have to, as a thorough accountant, kind of make a memo to say that, hey, this was for the purchase and the freight. The freight was 200. So you would have to figure out a way to convey that information in your accounting books. Okay, everyone good with this? This is like the hard part of the homework, just doing these journal entries and tracking the balances and making sure you're calculating the discounts on the net of returns, all that kind of stuff. That's the tricky part of this chapter.